If you recall in Chapter 10, we were accounting for the sales in a merchandising business. In this chapter, we're going to continue that study and look at how to account for merchandise purchases. Though we may say that our company purchased office supplies or purchased equipment or purchased furniture, in a merchandising business, purchases means inventory that we plan on reselling. When we purchase that inventory, we can purchase it on account or for cash. Now, before we purchase anything, we have to complete a purchase requisition because you can't just let any employee purchase anything without it being approved first. When an authorized individual sees that merchandise needs to be purchased, perhaps the inventory is getting low, they submit a purchase requisition. The requisition is then sent to their supervisor where it is approved, and then the merchandise is ordered. So the purchase order is completed, and that is just a written order to buy goods from a specific vendor. It includes the quantity of merchandise, the price of the merchandise, and a description of the goods. The purchasing department will review and approve the purchase requisition and then prepare the order. It's usually faxed in. And then when the goods are received, a receiving report is filled out because that is proof that the inventory was received and it was the actual inventory that was ordered. So the person receiving the goods has to sign for them, and that makes that person accountable for those goods because they were received in the receiving department. And then usually with the goods comes an invoice or a bill. So an invoice is prepared by the seller of the merchandise. Now the seller calls this invoice the sales invoice. The buyer, the person getting the bill, calls it the purchase invoice. But it's the same invoice, it's the same sheet of paper. Okay, now we'll look at discounts. Now these discounts will be listed on the invoice that we just referred to. Cash discounts are available if a bill is paid within a discount period. So this encourages vendors to pay promptly or pay early. So, and it also helps the seller out because the seller may get their money sooner. So the buyer refers to the discount as a purchase discount, and the seller calls it a sales discount. Okay, on the invoice you will see payment terms, and the invoice may say net 30. That means there's no discount and the invoice amount is due in 30 days. But if there's a discount involved, the invoice will say 210 net 30, which means there is a 2% discount if the invoice is paid 10 days after the date of the invoice. And otherwise, the full net amount of the invoice is going to be in 30 days. Now, a second type of discount is the trade discount, and it is much different from the cash discount. It's a reduction from the list or the catalog price offered to different classes of customers. For example, a hardware store may sell a 2x4 to a big contractor for $10. Whereas if you or I go in, we would be charged $15 for a 2x4. And the reason is the contractor places really big orders and does a big volume of business. So the hardware store wants to encourage that contractor to continue to come back. So they offer trade discounts to those contractors. These trade discounts are not entered in the accounts anywhere. The cash discount that we looked at in the previous slide, those are entered into the purchase discounts account. But the trade discounts are not entered on the books. They're just netted out of the list price, and that would be the purchase price that's entered on the books. And the difference between a cash discount and a trade discount is that cash discounts are usually really small. They can be 1%, 2%, 3%, whereas trade discounts are usually a little bit bigger, like 10% or 20%. Okay, now let's look at a new account called the purchases account. And the purchases account is used to keep a record of the cost of the merchandise that's purchased for resale. Remember, we can't put any purchase in there. We can't put the purchase of office supplies or the purchase of equipment in the purchases account. It's only for inventory. So this is the account that's debited when we purchase the inventory. It's called a cost account. So cost accounts are a lot like expense accounts. It's just where we accumulate costs of a certain type of item. And this purchases account is very important because it's going to help us calculate gross profit and cost of goods sold. Okay, so let's look at the journal entry. Assume a company purchases $575 of merchandise from key suppliers on November 2nd. So it's a pretty simple entry. We debit purchases. We know that this is a purchase of inventory or merchandise. The problem may say merchandise for resale. That's inventory. So we're going to debit purchases for $575 and credit accounts payable for $575 because it is on account. And notice we are going to put the name of the vendor or supplier next to the accounts payable account because just as we did in the previous chapter, when we kept up with the accounts receivable, we have to keep up with our vendors in the accounts payable. Okay, and we're going to do that in the accounts payable ledger. We have an accounts payable subsidiary ledger, which is just providing the detail for the general ledger accounts payable account. And we are going to keep every vendor or every supplier listed there. Okay, the accounts payable ledger looks a lot like the accounts receivable ledger. The name of the vendor with their address, and then there is a place for the date, and then the debit, credit, and then the balance. So what we need to remember is the balance in the accounts payable ledger is a normal credit. The balance in the accounts receivable ledger was a normal debit. Accounts receivable is a debit account and accounts payable is a credit account. The controlling account, as I mentioned earlier, is the accounts payable account in the general ledger. And then a schedule of accounts payable will be prepared at the end of the period, listing all the vendors and their balances, and the total must total back to the controlling account, which is the accounts payable total in the general ledger. Okay, so we'll take a closer look at that. Here we have an accounts payable subsidiary ledger. We have our vendors here, Bibb, Davis, Superior, and Twin City, and the balance at the end of the period. And to complete a schedule of accounts payable, we would just take those ending balances and list them on the schedule of accounts payable, total them up, and then make sure the total owed equals the general ledger balance of accounts payable. So the steps in posting to the accounts payable ledger are really similar to the steps in posting to the accounts receivable ledger. Enter the journal entry's date, enter the amount of the journal entry either in the debit or credit column, calculate the balance in the account and enter it in the balance column, enter the journal page number in the posting reference column, and then enter a check mark in the posting reference column of the general journal. Okay, and so when we prove our accounts payable ledger, we just add up the ending balances and make sure that they equal our balance in the accounts payable account in the general ledger. Okay, now we'll look at merchandise returns and allowances. So remember we had sales returns and allowances. Those were the returns and allowances that our customers returned to us. Now in this chapter we're going to have purchase returns and allowances that represents returns of purchases that we've made. So in merchandising, a return occurs when a customer returns to the seller part or all of the items purchased. An allowance occurs when the seller grants a customer a price reduction on items due to some factor like damage or defective. Okay, the seller calls the returns sales returns and allowances, and the purchaser refers to them as purchase returns and allowances. And there is a separate account where we're going to keep up with our purchase returns and allowances. It is a contra account, which is contra to the purchases account. So purchases is a cost account with a normal debit. Purchase returns and allowances is a contra cost account, so it has a normal credit. When a purchase return occurs, there is a document called the debit memorandum or the debit memo, and it is the buyer's written request to the seller for credit for a return or an allowance. So the buyer will decrease the creditor's account for the amount of the return when there is a debit memo. So here is a purchase return journal entry. So notice it's really the opposite of a purchases entry. When we purchased the merchandise, we debited purchases and credited accounts payable. In the return entry, we just flip that. We debit accounts payable to reduce it, and we credit purchase returns and allowances. So we're not going to mix our returns and allowances in our purchases account, so we have a separate account, purchase returns and allowances, just for those. Okay, so let's look at how that's posted. Here is accounts payable debited for $280. So we go to the general ledger and debit accounts payable for $280 and then reduce the balance by $280. Then we need a second posting where we post this debit to the accounts payable ledger. So we're coming to Master Ariel's accounts payable ledger. We're going to debit it, and then the balance goes to zero because it looks like we must have returned everything that we purchased from Master Ariel's. Okay, and then of course the purchase return and allowance is credited for $280, so we'll go to the general ledger to the purchase returns and allowances account, give it a credit of $280, which is going to increase the purchase returns and allowance balance. We'll have a credit and a credit, and we'll add that together to get a credit. Next we have the purchase discounts account. Now this is where all the cash discounts are entered for early payment. Remember the $210 net 30. The 2% would go in the purchase discounts account. and it's going to go on the credit side because it is also a contra cost account. So it's going to have an opposite normal balance as the purchases account. Okay, so let's review the credit terms a little bit. Over on the left, we've got 210 net 30. We've looked at this one already. There's a 2% discount off the sales price if the invoice is paid within 10 days of the invoice date. Otherwise, the total amount's due in 30 days. And here's 110 net 30. It works the same way, except instead of getting a 2% discount, you get a 1% discount. Now, these sound like very small discounts, but when you're buying large volumes of merchandise, these 1, 2, 3% amounts can really add up and be a savings for a merchandiser. Here's one that's a little different, 2% / EOM. So EOM means you'll get a discount if you pay by the end of the month. You get a 2% discount if you pay by the end of the month. Otherwise, the net amount's due in 60 days. And then we've got 310 EOM. And that just means you get a 3% discount if it's paid within 10 days after the end of the month. Otherwise, the total net amount is due in 60 days. Okay, so let's look at a journal entry that's paid within a discount period. Now, when we make the initial purchase, we don't know if we're going to pay within the 10-day period or not. So when we record the purchase, there's no discount ever entered unless it's a trade discount, which is netted out. But for a cash discount, we know at the time of payment whether we're getting the discount. So remember, the cash discount is entered at the time of payment. So we had a total of $575 owed, and there was a 2% discount if it was paid in 10 days, and it says that this invoice was paid within the discount period on November 2nd or November 12th. Okay, so we had initially put $575 in accounts payable. We debited purchases and credited accounts payable for $575. We need to clear the full $575 out of accounts payable because we are totally satisfying that account. So we need to offset the full $575 that we put in there earlier that we owed. Then we're going to write a check for 2% less. So $575 times 2% will give you $11.50 in discounts. So that goes over to the credit side because remember, purchase discounts has a normal credit, and then cash is for the difference. So just make sure that your two credits are equal to your debit. So even though we owed $575, we only paid $563.50, and then the $11.50 we earned as a purchase discount by paying early within 10 days. Now, if you've ever bought anything online, you know that there's some freight or shipping involved. And for a merchandiser, that can really increase the cost of the goods that they're buying. And there are some terms that we need to be familiar with in relation to the freight. One is FOB. FOB means free on board, and it's pretty much tells you who is paying the shipping and who is responsible for the merchandise at any point during the shipping process. So FOB shipping point means that the merchandise is free on board until it gets to the point of shipment. That means the seller is responsible for getting it to its shipping point, and then the buyer is responsible for getting it to them or to its destination. So FOB shipping point, the buyer is paying for the shipping to get it shipped to them. FOB destination means that the freight is taken care of all the way to the destination or all the way to the buyer. So the seller has agreed to pay for the shipping. So it's important to know who's responsible for the shipping, because whoever's responsible for the shipping is responsible for the goods. So if something happens in transit and it is shipped FOB shipping point, it's on the buyer. It's the buyer's responsibility. If something happens to the goods and they're shipped FOB destination, they belong to the seller. So the seller is responsible for the goods during the shipping. Okay, so in this example, it says the following journal entry indicates the $30 freight charge incurred by the purchaser under the freight terms FOB shipping point. So FOB shipping point means the buyer is having to foot the cost of the shipping. So we have merchandise worth $700. The shipping is $30, so we're going to debit freight in for the $30 shipping, and then we'll credit accounts payable for the full $730. Okay, now this purchases account, purchase discounts, purchase returns, freight in, is going to help us to calculate gross profit. Gross profit or gross margin is really important because it tells the owner or the manager of the company how much they have in sales dollars to cover all their other expenses. So the gross profit has to cover the light bill, all the wages, the insurance, and all the other costs of running a retail store. So the gross profit is a very important figure. So its calculation is net sales, which we calculated in Chapter 10. Remember that sales minus sales returns minus sales discounts gives us net sales. And then we're going to subtract the cost of goods sold. And then the difference between those two is the gross profit. So net sales is what we've collected from our customers, and then cost of goods sold is what that inventory that we sold actually cost us. And then gross profit is the difference. So that's the profit that we have made on all our sales. So let's look at cost of goods sold a little more closely. We know how to calculate net sales. Cost of goods sold is a much longer and a little bit harder process. So it's also called the cost of merchandise sold. It's the difference between the goods available for sale and the ending inventory. And it indicates the cost of the goods that we sold during the period. All right, so I'm going to do a little simplified explanation, and hopefully you'll be able to follow it and understand the calculation involved in cost of goods sold. So in getting the whole gross profit, we start with calculating net sales. So we know from Chapter 10 that that is sales less returns, less discounts gives us net sales. So here's the example. During the year, a company sold 25 hats for $10 each. So our sales were $250. That's 25 times $10. Some of the sales were returned by our customers, and some of our customers got discounts. So we had $30 in returns and $20 in discounts. So net sales would be $250 less the $30 less the $20. So net sales is $200. Okay, so we're going to take that net sales and set it aside for a minute, and now we're going to start the process of calculating the cost of goods sold. And we're going to start with calculating the cost of goods purchased. Okay, so during the year, how much did we purchase in goods? So we can look in our purchases account and then figure out of those purchases how much we returned how much was extended in discounts, and then the freight we paid to get the merchandise to us. So that gives us the cost of goods purchased. So during the year, a company bought 18 hats for $3 each. We returned some, and some got discounts. And it says the purchases were $54, so that'd be 18 times 3. Okay, so 54 less $6 in returns, less $1 in discounts, plus $3 for freight. So that tells us that we purchased $50 in goods during the period. Okay, that's a really important number in getting our cost of goods sold. All right, the next step is to calculate the cost of goods available for sale. Okay, so we started the year with some inventory already. So typically, you know, a company doesn't empty out their store on December 31st. They try to, I guess, with end of year sales, but they still have merchandise left over. So on January 1st, there's a beginning inventory. So in this case, this company had $25 in beginning inventory, and then we purchased $50 more in inventory. So the total goods that we could have possibly sold during the year was $75. That's our beginning inventory plus the purchases that we just calculated in the previous slide. So we know we've got $75 worth of merchandise in our store to sell for the year. Now if we subtract out the ending inventory from that figure, we'll get our cost of goods sold. So we had $75 in goods available for sale. Our problem tells us that we have $30 in ending inventory. So that means that the goods we sold cost us $45. So let's look at that again, because this is a real important calculation. This is everything we had to sell. At the end of the year, we took ending inventory, and the only inventory we had amounted to $30 worth. So if we started all year with 75 and we've only got 30 left, that means $45 was sold in merchandise. So that we know that our cost of goods sold was $45. Our net sales, remember, was $200. If our cost of goods sold is $45, then our gross profit is $155. So this calculation will now be the top portion of your income statement for your merchandising company.